And today I'm going to do a little bit of a case study. Think of this. You're a business owner and you started out, things were going pretty well. And then in the last couple of years, things have absolutely blown up. You're making over $1 million a year and all of a sudden you see your tax bill and you're like, oh my gosh, what do I do? But on top of that, taxes aren't the only thing that matters. You need to think about what to do with the extra money. Do you keep it in the business? Do you take it out of the business? Are you doing all the right tax things? How do you plan for your wealth? What can you afford income-wise? What can you afford to buy house-wise? What can you spend a month? These are all the things that we're going to go through today. This is a common thing that happens with me and my clients. So most of my clients coming in are making well over $1 million a year, and they're just looking for somebody who can help them navigate all the complexities. And so this is how we'd think through it. The first thing that we'd do is we'd start to think about entity election. Most of these solo business owners coming into working with us, the issue is that they're a sole prop. Sole props are an okay place to start, not a good place to be long-term. First of all, they are 10 times more likely to be audited because they don't have the same record keeping requirements as other businesses. So what you want to think about here is what's the right entity election. The reason why sole prop most likely is not is because one, you're going to have a ton of self-employment taxes. You're making that $1 million, right? You're paying 174,000. You're basically paying this 15.3%, and then you're paying 2.9% the whole rest of the way. Whereas if you were an S-Corp, potentially, you wouldn't have all those self-employment taxes. On top of that, a lot of these clients live in states that have PTET. If you live in California, New York, Illinois, Missouri, Indiana, etc., you will not have the ability to elect into PTET. Electing into PTET basically allows you to pay your state taxes through the business. So let's say you have 100,000 of state taxes. If you're a sole prop, you're just paying those state taxes. If you are an S-Corp and you're elected into PTET, you get to pay those state taxes through the business and then deduct that $100,000 federally. This for this person would be, about $37,000 of tax savings. Extremely impactful. For most high earners in this situation, S-Corps or partnerships end up being the best move. So if you think about it, if you have $1 million, you're an S-Corp, and you have a $250,000 salary with $750,000 of profit, you're going to save on self-employment taxes by that 2.9%, which is pretty close to $20,000 of tax savings just by moving to the S-Corp. On top of it, in this situation, that salary is more than enough to max out a solo 401k, which we're going to talk about later. To recap, entity election is the number one thing. If potentially partnership makes sense with your spouse if they're helping you work. If not, potentially S-Corp makes sense because it's going to have self-employment tax savings. This is going to allow you to get into PTET. And those are really impactful tax planning moves that a lot of people are missing. The second thing is we're going to need to make sure we hit safe harbor tax payments. Most people, when their income is starting to grow really quickly, they are nowhere close to making their safe harbor payments. Safe harbor payments basically means that you're paying quarterly taxes and enough to avoid paying penalties. Time and time again, I'm working with clients that come in paying $10,000 to $25,000 a year in underpayment penalties, and they don't even know about it because they don't even review their tax return. What safe harbor payments are is you can either pay 110% of your prior year's liability. So if you owed $100,000 last year, this year you need to get in $110,000 equally throughout 4 quarters, or you can get in 90% of your current year's taxes. So when does each one make sense? If this person made $500K last year and they're going to make $1 million this year, 110% makes a whole lot of sense. Why? Because they get to pay in way less throughout the year. If they were to do 90% of the 1 million, then they're going to have to pay in significantly more. And there's just really no reason to pay in more when you could pay in less, save it, get good cash yields on it, keep liquidity, etc. The other part about it is if you're an S-Corp, you have the ability to do this through withholding. So let's say you need to get 110 in and you're paying yourself a $250,000 salary. You could basically in December run a bonus payroll for $150,000, withhold 110K and kind of use that as a band-aid and be good to go. But at the end of the day, what really matters is that you hit these safe harbor numbers. And one thing that I found that most people don't know is you also have to do this for state taxes. But some states are different. California, for example, doesn't have the regular 25% each quarter. I'm pretty sure it's 30, 40, 0, 30. But on top of that, if you make over $1 million in California, they require you to go to 90%. You can't just use the 110% from prior year. You have to hit that 90% number. And so this is why you shouldn't be going at it alone. There's so many rules. There's so many things that you want to get right and optimize, and you need a team behind you helping you do it. The next one would be set up the right retirement account. Time and time again, I see people who should have solo 401ks have SEP IRAs, or businesses that have simple IRAs when they should have traditional 401ks. But for this solo owner, the one thing that you're going to want to do is you're going to want to have a solo 401k. So if we go back to this example of $250,000 salary, they'd be able to get in the 23.5 employee side contribution, and then the employer to get them all the way up to 70K. If they're over 50, they'd have the additional $7,500 catch-up contribution as well. If somehow their salary was too low for a year and they paid themselves 100, then they'd have to do mega backdoor Roth to get up to that 70,000 number. The other thing that you can consider, which goes in my next one, is hiring your spouse. So for most solo business owners, you should hire your spouse. Plain and simple, right? You should consider, can I bring them on? Can I pay them enough so that way they can use the solo 401k? Maybe they're going to do, bookkeeping. Maybe they're going to do some admin work for you. Maybe they're going to do client gifts, whatever it is, find work for them to do. Because if you can pay them, let's say like 25 to 20 to 30,000, they can get in 23,500 of the solo plus 25% of the W-2 wages. If you have enough to get them to 70, they could do 23.5 employee side, 25% of 70 employer side, remaining room via mega backdoor, and you can get $70,000 in a retirement account for them. If you're a partnership with your spouse, this also becomes easier. What amount of the profit flows through to them? Let them use retirement accounts and be good to go from there. The next thing that you're going to want to do is maximize your deductions. A lot of solo business owners don't have a ton of expenses, but you want to do everything you can to get expenses into the business. One of the best parts about being a business owner is you get to spend before tax. So this could be phone, it could be internet, it could be home office, it could be travel for business. There's a lot of good things there. It could potentially even be a vehicle if you have to travel quite a bit. But spending before taxes is one of the greatest advantages you have as a business owner. And know that if you're an S-Corp, you don't really get to do it in the same way. You have to do it through an accountable plan, which is basically you reimburse yourself each month for the expenses or the amount of the expenses paid. The next thing that you want to think about is how much cash to hold in the business. Business owners all the time hoard cash. They sit there and they just keep stacking it because they don't know what to do with it. But you want to view your business and your personal finances in the same way. You want an emergency fund and you want funds for short-term savings. Any dollars above that should get taken from the business and they should be used to grow your wealth. You're going to have your operating account. Keep cash in there. Your emergency fund, your tax savings account, etc., that should be in a high yield savings account. We help make sure all of our business owners have high yield savings accounts set up. This could be places we invite them to. You could also just kind of set up a brokerage account in the business's name. And what you could do there is you could put money in a money market fund, but you want to make sure you get a yield. Dollars above that, you want to distribute and go use to build wealth outside of the business, which is honestly the seventh point that I wanted to hit on. Take money out of the business, build wealth out of the business. Especially in this example, if you're a solo business owner, you are probably not going to have a business that's worth selling because it's just you, right? You haven't built something that somebody could just plug into most times and be okay. But even if you could, you still don't want to only be concentrated in your business. So you want to take that excess cash out to build wealth. This could be maxing out solo 401k for you. This could be solo 401k for your spouse. This could be backdoor Roth IRAs. This could be maxing out an HSA. This could be adding to a taxable brokerage account. This could be 529s for kids' college. This could be buying real estate, right? Different ways of building wealth outside of the business and taking advantage of this opportunity. If you're this business owner and you're making $1 million, you need to understand that this is rare. I work with a ton of people in this position. Almost all my clients are in this position, but it is not normal. This might stay. It might continue to grow. This also might be a weird period of time where you're going to make a bunch and you're never going to make this much again. So what you want to do is you want to really take advantage of this income. You want to potentially get ahead on college for your kids, get ahead on retirement. This could be paying down debt. This could be building excess savings. The key here is you just don't know how long this income will last. So do everything you can to use it to get ahead financially. The next one is understand what you can spend. One of the biggest pieces of advice I give to my clients in this position is to always set your budget based on what you made 2 years ago. Why? Because then you have enough data, right? If you make $1 million this year, what if you only make 300K in 2 years. But if you've made $1 million, 1.2, 1.3, 1.4, 1.5, okay, I go back 2 years and I was making 1.3, great. I have a lot of data to show that this is probably what I'm gonna make. What did I make 2 years ago? Okay, now I can figure out how much house can I afford, what can I spend per month, and always use a 20% investment rate. I advise all my clients to say, hey, if you make $1 million, you need to invest $200,000 a year through all your various options. From there, then you can go figure out how much that you want to spend. But if you start with spending and then invest what's left over, you're always going to end up short. Start with 20%, make decisions from there. And the last one would be consider a cash balance plan. Cash balance plans are basically another deferral tool. So this person making over $1 million, they're gonna have their solo 401k, but then they can add a cash balance plan, which allows you to defer another about $100,000 to $300,000 per year. But there's a few things to note. It is really good for deferral. Between this and your solo, you might be deferring, $100,000 to $350,000 a year, but you need to have a strategy later for how then you're gonna convert these or how you're gonna get this out by paying lower tax than today. Because if you just pay the same tax, might not have been the best option. Some of the downsides of cash balance plans are there's a hurdle rate that's a pretty low hurdle rate, about 4% sometimes. So you can only invest and grow at about 4%. If you grow more than that, then it reduces what you can end up putting into the plan the next year. You have a lot of costs. You have an actuary that has to oversee this plan because they're targeting a pension in the future. That's going to cost, maybe about $3,500 a year. On top of that, if you use it, you typically have to put in less into your solo 401k on the employer side. Between the two, you can really only get to about 31% of your income. So you can do the cash balance plan and then you're able to do 6% profit share from the solo 401k. The other part is that you typically have to commit to this for at least 3 years. And so one planning tip I give to most of my clients is if you want to do this for 25, let's extend your taxes because you can do your cash balance plan till then. We're going to do it basically in October of next year, once we already know what you're going to make next year. And then all we have to do is be able to make it one more year and we're good to go. If you are a business owner, it's blown up, you make over $1 million, understand that in the front of your mind should be tax planning. This is entity election, right retirement accounts, hiring spouses, minimizing self-employment tax, maximizing QBID, and then it's how do I use this money to build wealth and get ahead and manage this business correctly. And if you're doing that, you're gonna be ahead and you're gonna be really happy with where you're at financially 10, 15, 20 years from now. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.